Hey everyone, welcome back to Corporate Decoder. Today, Traws Pharma Incorporated's latest 8K filing dropped, and it looks like a major plan change is afoot, but I am seeing something else that caught my eye. Quick note, this is not financial advice, just my take on public filings for educational purposes. The big news is an update to their employee incentive plan, but the real story might be what this signals about their stock strategy. So what is going on here is Traws Pharma Incorporated is filing a current report, essentially an alert to investors about significant events. This particular filing is triggered by an update to their employee compensation plan, specifically their 2021 incentive compensation plan. This form, the 8K, is like a company's immediate bulletin board for important news that investors need to know right away. Think of it as an emergency announcement system for things like big executive changes, bankruptcies, or in this case, changes to employee stock plans that could impact the total number of shares out there. Now, Traws Pharma Incorporated, or TRAW as you'll see it on the stock market, operates in the healthcare and biotechnology sector. They are a smaller company with a market cap around $12 million and a current stock price of about 76 cents. They have a very lean team, just 4 employees. Looking at the stock itself, their common stock trades on the Nasdaq under the symbol TRAW, and it is listed on the Nasdaq Stock Market LLC. This is important because it means they have to meet certain rules and transparency requirements to stay listed. The core of this filing revolves around a change to their incentive plan, approved by shareholders on the 8th of July 2026. What they did was amend their 2021 incentive compensation plan. The main point of this amendment was to add 2 million more shares of common stock that can be given out to employees or executives, likely as stock options or grants. This change happened at their annual shareholder meeting. Usually these meetings are where big decisions are made, and shareholders vote on things like electing directors and approving major company plans. Let's look at the voting results for this specific proposal. The plan to increase the number of shares available for issuance by 2 million passed. It received 48 to 1796 votes in favour, with 1,694,075 votes against and only 6,690 abstentions. This shows a clear majority of voting shareholders supported this move. This number, nearly 4.8 million votes for the amendment, indicates strong support from those who voted. However, it is also worth noting the over 1.6 million votes against it. While the proposal passed, this level of opposition suggests some shareholders might be concerned about potential dilution. And you see this 1.9 million number in broker non-votes across several proposals. These are shares held by a broker on behalf of a client where the broker did not receive voting instructions. Beyond the incentive plan, they also held elections for their board of directors. 7 directors were up for election, and all of them were elected to serve until the 2027 annual meeting. For example, Ian Dukes, D-Phil, received 6448795 votes in favour, showing overwhelming support for him to continue on the board. This indicates the shareholders are largely comfortable with the current leadership and direction of the company as represented by the board. They also re-ratified KPMG LLP as their independent accounting firm for 2026. This is pretty standard procedure, ensuring that an independent auditor is in place to review their financial statements. It received a huge number of votes in favour, 7,659,805, with only 789,757 against. This massive vote of confidence for KPMG means the shareholders are happy with the auditor's work. Now, here is where things get really interesting and potentially more concerning. Proposal 4 was about approving the issuance of more shares related to some warrants that were issued back in April 2026. These are essentially rights to buy stock at a certain price. This proposal to approve the issuance of shares from these warrants only got about 2.2 million votes in favour, and it had 151,196 votes against. The asterisk here is key. It points out that this voting total excludes 3.4 million shares. This exclusion is because of Nasdaq listing rules, which means these specific shares were not allowed to vote on this particular proposal. This is often related to certain types of stock or warrants that might not have voting rights or could cause ownership issues if they were factored in. And again, we see those 1.9 million broker non-votes here as well. Looking at the financials that we can infer here, adding 2 million shares to the incentive plan, plus whatever shares are issued from these warrants, could lead to significant dilution for existing shareholders. We've seen this pattern before with smaller companies. This is particularly relevant in light of recent news from the 10th of July, just after this filing mentioning Traws Pharma is setting up a $5.6 million at the market, or ATM share sale. An ATM offering means a company can sell shares directly into the market over time. This is often a sign that a company needs cash, and they're willing to dilute existing shareholders to get it. Historically, companies that resort to frequent share issuances and ATM offerings, especially at lower stock prices, often face a tough road. For instance, we saw companies like Radio Shack engage in multiple dilutive share sales, leading up to their eventual bankruptcy. While Traws Pharma is not there yet, these moves are definitely watched closely. What is concerning is the combination of increasing the share pool for a compensation plan, and then approving further share issuances from warrants, all while signaling a need for cash through an ATM offering. It suggests a potential strategy where the company might be trying to fund operations by selling more stock, which can put downward pressure on the share price. Interestingly, they also had a proposal to adjourn the meeting if needed, which passed with a large majority, 7,882,130 votes for. However, they didn't need to adjourn because all the material proposals, including the one to increase the share pool and the ones related to warrants, were approved. The filing also lists some exhibits. The most important one here would be Exhibit 10.1, which is the actual first amendment to the Traws Pharma Incorporated 2021 Incentive Compensation Plan. This is the document detailing exactly how that added 2 million shares can be used. This exhibit is where the nitty-gritty details of the incentive plan amendment are laid out. My biggest concern is the potential for significant dilution, especially when coupled with the ATM share sale announcement. While increasing the share pool for employee incentives is common, doing so at this stage, alongside warrant exercises and a cash-raising ATM offering, raises questions about the company's financial health and its strategy for survival. It's a delicate balance between incentivizing employees and protecting the value for existing shareholders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.